Last year alone, I saw hundreds of retirement mistakes, and I don't want you to make those mistakes as you head into 2024. So we're going to cover the top 5 in this video. Some of these retirement mistakes can be the number one killer of your retirement. It can cost you more money in taxes, put less money back in your pocket, or cause less money to go to your estate, your charity, kids, whoever it is that you want to leave the money to. Wouldn't you rather leave it to them versus CRA? These tips will help you move in the right direction. Before we jump into it, if you're not already subscribed to the channel, which is more than 50% of you, hit the subscribe button, join the community. We release 2 new videos every single week on retirement tax and estate planning. The first and by far the biggest mistake is making an irrational decision around when to take either your CPP or old age security. Timing on when to take these government benefits is definitely the hottest topic on our channel and on many retirement channels. Make sure you understand when it's best for you. Again, I always talk about delaying CPP, possibly delaying old age security. It does make sense for the majority of you, but there's also the psychological barrier, and there's many other factors that go into it. So even though the numbers may make sense to take it at 70, there may be other reasons to take it earlier. But don't let that be an irrational decision, like your neighbor doing something or something happened in your life where you're like, I just need to take it. Or a conspiracy theory, which I often hear. So make sure you understand the hard facts. When it makes the most sense for you, have a professional run those numbers for you to see how it works in. And remember, your CPP and OAS, they're 2 of many income streams in retirement. Don't look at them as individual silos. If you do, you're going to take them at the wrong time. They need to integrate with the rest of the assets you've built up over time. I'm going to do a video here in the next few weeks around what happens if you both maxed out your CPP as you head up to 65. Is it worth delaying it? What happens if someone dies early? I'll cover all that in a future video. The second biggest mistake we saw last year was people not unlocking their LIF when they move it from a LIRA to a LIF. And what I mean by that is when you have a LIRA, typically a LIRA will come from an old company pension plan. You left the work or maybe you retired, and your defined contribution plan typically rolls into a LIRA, locked-in retirement account. Now that LIRA account is like an RSP in essence, in that when you retire, you can start drawing money out. The difference is that when you start drawing money out, there's going to be a minimum, much like a RIF, but there's also a maximum, so it's more of a constrained account. Now, depending on the legislation of your LIRA, meaning is it registered in one of the provinces or federally, you can unlock part of it. And what I mean by unlocking is you can move half of it or up to the whole thing potentially into your RSP and have more flexibility around that money and how you take it out. So if you're someone that's entering into retirement with a LIRA, locked in registered account, so look at your statements. If you see a LIRA, there's a point where when you start taking money out of it or need money out of it, you roll it over to a LIF, a life income fund. When you do that, check to see if you're able to unlock any of it. And if you are, make sure you unlock as much of it as you can. And if you're not sure if you're able to unlock it or not, you can go to parallelwealth.com/LIRA, and it outlines which provinces, territories, and federally legislated LIRAs you are able to unlock. So figure out which legislation your LIRA is, and you can do that by contacting your financial institution, and then look on our website to see, can I unlock it? When you convert it from a LIRA to a LIF, at that time, on the conversion form, it'll say, do you want to unlock it? Again, if you need help with that, talk to whoever you deal with at your financial institution, and they can walk you through that. But make sure you unlock as much as you can from the LIF to an RSP or to a RIF, so that you can have the most flexibility around taking that money out through retirement. The third biggest mistake, and probably the most stressful to retirees, is not matching your investment portfolio or your investments period to the cash flow needs of your retirement plan. And this is why it's really important to have a retirement plan. Where does my money come from in retirement? How do I draw it down? Once you have that plan, you know how much and from which account your money is going to come from. Well, that makes it easy, right? If you had an Excel spreadsheet that said, here's your 5 different income streams, and here's every year you need to take money out of, it's quite simple to kind of map that out, right? You might have to update the plan and whatnot as you go forward, but at least you know for the next year, year after that, probably year after that, you know how much and where that money is coming from. That means you can actually look at your investments and structure things in a proper way to meet the cash flow needs to avoid market downturns. So let's say your RIF account, you need to take out $20,000 a year from that RIF. you can look at your RIF investments and say, well, in the next 3 years, I need $60,000 out of there. So why don't we kind of move over time or maybe short term, depending on how it's currently structured, some of the money in your RIF, investments in your RIF, to a shorter term investment vehicle that isn't fluctuating with the market. So when you need your $20,000 this year, next year, the year after, you're able to draw that money out regardless of what the market's doing. So if the market's down 20%, that's fine. I moved my 20 grand I need into cash already. I'm good to go. And that's why it's really important to know what cash flow you need and then build your portfolio. For a lot of our clients, we'll say, you need 20 grand, you're getting 10 off dividends. So we just need another $10,000 of cash or maturing bonds, something that's not tied to the stock market or any high risk vehicle, so that we can naturally produce that cash flow regardless of what the market's doing. And that brings a lot of peace and comfort as you walk through retirement, because these big market fluctuations we're going to continue to see don't determine how much money you're going to draw down in retirement on an annual basis. The fourth mistake I see, and this is very costly on the tax side, is in the first few years of retirement, I talk to a lot of people that create zero taxable income for themselves in those first 1, 2, 3 years. They retired, they maybe got a severance package, they're living off their tax-free savings account, whatever it is. There's many different reasons or excuses I've heard. But basically for a year, 2 or 3 years, they've had income, but it's all been non-taxable. So they paid zero tax, which in theory sounds fantastic. We all want to pay zero tax. The reality is, as we go through retirement, we're going to have to pay some tax. Unless you're in a very, very low income tax bracket, low income period, you're going to pay some tax. And if you want to pay the least amount of tax over the span of your retirement, you don't want a zero tax year. You want low tax years, but you want them leveled out. So make sure as you enter into retirement, you don't have a zero tax year. You have a very low tax year, hopefully, but not zero, because it's all you're doing is pushing that tax later, which typically creates more of a tax bill to CRA over time. So as you enter retirement, again, one of the benefits of having a plan is to just know, how much income should I draw that's taxable versus not taxable? How much tax am I going to pay? What's my average and marginal tax rates? These are all things you should know as you enter into retirement. The fifth and final biggest mistake I see would be people not having a retirement or income plan as they enter into retirement. And to me, it's crazy, because entering into retirement is one of the biggest tax planning events we have in our lifetime. If you're an employee, if you're a business owner and you've had a lot of opportunity for tax planning and all that kind of stuff throughout your lifetime, there's a lot of tax planning you can see in retirement. But for most of us that are just employees, when you enter into retirement, it is your biggest tax planning event in your lifetime period. There's a lot of tax planning you can do as you enter into retirement to make sure that you put more money in your pocket versus CRA. It's very different than when you were just working. And our clients realize that. If you've ever done a retirement plan, you realize that. There's a lot of opportunity. And a lot of you are skipping out on that because you don't trust your advisor or you don't want to pay for a financial plan. And I can tell you, by doing hundreds and hundreds of plans our team has done over the last few years, you're going to save much, much more than what the initial cost is. So whether you have a financial planner, meet with them, run different scenarios, see what the best scenario is for you around all your income streams. If you don't have one, you can hire a fee-for-service financial planner. Our firm has a team of financial planners that does this. They're all on payroll, so they're not selling you anything. We are an independent financial planning firm that does fee-for-service planning, meaning you're hiring us as consultants. We grab your information and we map it out in the best strategy, look at different options, figure it out, and say, here's how, and we show you how and how to implement it and move forward with a better retirement. So as you get closer to retirement, maybe you're already in retirement and you're sitting there saying, Adam, I've kind of been scrambling for the last few years and I have no plan. I need something. Give us a call, contact our office, and we can get that process going for you. Or talk to your financial planner if you have one already. Not your investment advisor. Okay, this is what mistake a lot of you make. You go to your investment person. No, this financial planner is someone that does plans. We don't do investments, we do planning. That's all we do. Our whole team. We have 6 financial planners. All we do is financial planning, retirement planning. So make sure you're talking to the right professional, because a lot of you are reaching out to the wrong person. Talk to your financial planner, get a plan in place, and make your retirement that much better. Put more money back in your pocket, pay less in taxes, and just have a clear plan. Bring that peace of mind. Enjoy retirement.